Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation, and needs. Welcome to This Week in the Markets. Today we'll be covering intermarket relationships, FX markets, Bernanke, and bubbles. Yes, bubbles. In commodity markets, studying the relationship between the US dollar index and gold reveals some startling results. The dollar index has rallied from 79 to 82.5 recently, pretty much in line with falling gold and oil prices in the same time period. If the index has hit its top, then gold may have also formed its bottom, and the inverse relationship may play out with gold rallying and the dollar index falling. In their own right, however, it seems as if gold is sitting at a key level and closing below 1570 might trigger more sell-off. However, if the current level holds and the metal goes on to form higher lows, we may see the beginning of an uptrend. The same analysis can pretty much be applied to the dollar index, which coincidentally reinforces the inverse relationship between the two. In FX markets, the dollar-yen has progressed further, hitting a high of 95.56 on Friday. Technically, the stochastic is traveling through its overbought region, and the RSI has just entered its respective overbought region. However, looking at the moving averages, the 5-period MA is just over the 14-period EMA, which is just above the 20-period MA, all suggesting more bullish trend, which is not unexpected in this market due to recent events at the BOJ. In the Euro-USD market, the bears have pushed the pair back below the 1.30 line. Keep an eye on support at 1.285, the 50% Fibonacci retracement from the 2012 lows. Two factors now could push the pair lower: upcoming events triggering risk or a reversal of the ECB's balance sheet, which is not very likely at the moment. And towards the end of the week, one may also find the Brussels meeting also to be an important catalyst. The US Federal Reserve Chairman Ben Bernanke has mystified market participants on how the central bank intends to unwind its balance sheet. Big Ben asserted in his testimony recently that the Fed does not have to sell assets ever. In doing so, Bernanke has raised questions on how the bank then plans to stop prices from accelerating. Removing asset sales out of its exit strategy essentially leaves interest rates the only tool for controlling prices. Bernanke stated that such tools have been used frequently by central banks and they seem to work, apparently. Using short-term interest rates as its prime tool would mean it would take longer to normalize the Fed's balance sheet, as the organization currently holds bonds of up to 10 years to maturity. The Fed's second in charge, Janet Yellen, further stated that the organization does not intend to sell assets until after it begins to raise interest rates, probably after it has exhausted the interest rate portion of monetary policy. Now, such a policy only dictates that the Fed wants to see markets higher and higher, and eventually, using the asset sales to unwind a record $4 trillion book, the organization may pretty much induce what may be the biggest black swan event of our time. This brings us to the next chapter of the story, bubbles. Alan Greenspan had a ball of a time creating a bull market from 2002 right up to 2007 after the slump from the end of the tech boom. As usual, interest rates were low, derivatives were deregulated, and the Graham-Leach-Bliley Act, allowing the consolidation of commercial and investment banks, were put through. And the Bush tax cuts of 2001 and 2003 went through, of course, and not to mention the subprime house ownership bubble. All of these set up the markets for one giant bull. And this bubble lasted to 2008 as the housing bubble popped, and a series of unfortunate events took the S&P 500 back down to the 600s. Now in comes big bad Bernanke, flaunting his Kiwi guns and keeping interest rates low, in effect creating an asset bubble as the Fed balance sheet grows to $4 trillion. And now the S&P 500 is just a few points away from all-time highs. Will the stock markets break the highs? Probably. Will the break continue? Who knows? It could even be a false breakout, inducing the average person into long position just when the run could be over. Another point to consider will be if history is to repeat itself, what global events could drive these trends? We could have a retracement before the market actually booms and breaks the level with conviction. In Japan, 3 opposition parties have supported the BOJ Deputy Governor nominee Kikuo Iwata, ensuring his place in the leadership team. The Democratic Party, however, has said that they will back Kuroda in this week's vote, but may still oppose him when he is re-nominated in April. Now the first vote is just to confirm Mr. Kuroda completes Mr. Shirakawa's term. And that brings us to the end of this week's presentation. All the best and happy trading. Thank you.